Your money may look safe today, but the rules around it are quietly changing. By 2026, new UK taxes and laws could reshape how much you keep, save, inherit, or spend without any dramatic announcement. Council tax bans, pensions, online income, property moves, and even savings interest are all under review. Small adjustments on paper can translate into hundreds or thousands lost over time. Most people only notice after the first bill arrives. This video breaks down what's coming, who is most affected, and how everyday households can prepare early, stay flexible, and protect stability before these changes become unavoidable. Number 1. Expanded council tax revaluation. Council tax in the UK is expected to face a major revaluation by 2026, and this change could directly affect how much households pay each year. Many properties are still taxed based on values from decades ago, which no longer reflect current market prices. Under a new revaluation system, homes that have risen sharply in value may be moved into higher tax bands. This is especially important for homeowners in fast-growing areas, where property prices have surged without council tax being updated to match those increases. For families, retirees, and people on fixed incomes, this shift could place extra pressure on monthly budgets. Even a single band increase can result in hundreds of pounds more per year, quietly reducing disposable income. Renters may also feel the impact, as landlords often pass higher council tax costs into rental pricing. Local authorities argue that revaluation creates a fairer system, but the timing matters when living costs are already stretched. To prepare, households can start by checking their current council tax band and comparing it with similar properties in the area. If a revaluation pushes a home into a higher band, residents may still have the right to challenge the assessment. Budget planning is another key step, as setting aside small monthly amounts now can reduce financial stress later. Understanding how council tax works allows people to respond proactively, rather than being caught off guard when revised bills arrive. Being aware early also gives people time to seek advice, review discounts or exemptions, and make informed decisions that protect household finances as policies evolve during upcoming fiscal adjustments across local councils nationwide and regional housing markets overall. Number 2. Changes to inheritance tax thresholds. Inheritance tax rules in the UK are expected to tighten by 2026, potentially affecting far more families than before. Current tax-free thresholds have remained frozen for years, while property prices and asset values continued rising. As estates grow on paper, more households may cross the taxable limit without feeling particularly wealthy. This shift means families could face unexpected tax liabilities at an already emotional time, reducing the amount passed on to children or dependents. These proposed changes are often linked to government revenue needs and long-term fiscal planning. However, the real impact is felt at household level, especially among middle-income families whose main asset is their home. A modest house purchased decades ago could now push an estate above the allowance. Without preparation, beneficiaries may be forced to sell property quickly to cover tax bills, limiting financial stability during a period of loss. Practical planning can reduce exposure to these risks. Reviewing wills, understanding gifting rules, and exploring available reliefs can make a significant difference over time. Small annual gifts, when done correctly, may lower estate value gradually. Professional advice can help families structure assets efficiently while staying compliant. Early conversations within families also reduce conflict, clarify expectations, and prevent rushed decisions, allowing heirs to focus on long-term security rather than immediate cash pressures during difficult transitions that arise from uncertainty, poor communication, and last-minute arrangements made under stress, especially when legal deadlines and financial obligations are approaching rapidly without clear guidance or prior planning in place early. Number 3. Increased capital gains tax on assets. Capital gains tax is expected to change by 2026, with proposals suggesting higher rates and reduced allowances on profits made from selling assets. This includes property that is not a main residence, shares, business assets, and certain investments. As asset prices have grown faster than wages, governments increasingly view capital gains as an untapped source of revenue. For everyday investors, this could mean a larger portion of profits going to tax rather than personal savings or reinvestment. The impact may be strongest for small landlords, side investors, and people selling long-held assets to fund retirement or major life events. A higher tax bill can alter decisions about when or whether to sell, sometimes forcing people to hold assets longer than planned. Market timing becomes more complex, and sudden policy changes can catch sellers unprepared. Even modest gains accumulated over many years may attract significant tax, changing the real value of what people thought they had built. Preparation focuses on awareness and timing. Knowing current allowances, tracking purchase prices, and keeping records of improvements helps reduce taxable amounts. Spreading asset sales across multiple tax years may also lower exposure, depending on individual circumstances. Some may consider using tax-efficient accounts where possible, while others may review ownership structures with professional guidance. The key is understanding that capital gains are no longer a concern only for the wealthy. As rules tighten, ordinary households with modest investments may feel the effects first, making early planning an essential part of protecting long-term financial goals and avoiding rushed decisions that reduce flexibility, limit options, and increase stress during already important financial moments later in life. Number 4. Pension tax relief reforms. Pension tax relief in the UK is likely to change by 2026, affecting how much value individuals gain from saving for retirement. Current relief allows contributions to be topped up through tax savings, but reforms may introduce flatter rates or tighter limits. Higher earners could receive less benefit, while lower earners may see smaller incentives to increase contributions. These adjustments aim to rebalance public spending, yet they also reshape long-term retirement planning for millions of workers. For employees and the self-employed, reduced relief can quietly shrink future pension pots. A contribution that once felt efficient may no longer deliver the same return, especially when combined with rising living costs. Older workers planning late-stage savings boosts may be most affected, as they rely heavily on tax efficiency. Employers may also adjust workplace schemes, changing matching structures or contribution guidance, which further influences take-home pay and retirement expectations. Preparation begins with understanding personal pension arrangements and how relief is currently applied. Reviewing contribution levels, exploring salary sacrifice options, and balancing pensions with other savings can restore flexibility. Independent advice helps align retirement goals with evolving rules while avoiding unnecessary tax exposure. Staying informed allows individuals to adjust gradually rather than reacting suddenly to confirmed reforms. Early action preserves choice, supports stability, and protects future income streams as the pension landscape continues shifting under fiscal pressure and demographic change. This approach strengthens confidence, improves forecasting, reduces anxiety, and ensures retirement decisions remain deliberate, measured, and resilient despite policy. Uncertainty, market volatility, employment transitions, inflation risks, longevity trends, and changing government priorities affecting savings behavior across different income groups nationwide over coming years ahead. Number 5. New environmental and carbon-related taxes. Environmental taxes in the UK are expected to expand by 2026, with stronger focus on carbon emissions, energy use, and sustainability targets. These measures may include higher fuel duties, expanded carbon pricing, and additional levies on high-emission activities. While designed to encourage greener behavior, they also increase everyday costs for households. Heating homes, driving to work, and using electricity could all become more expensive, particularly for people with limited alternatives. The financial impact may fall unevenly across society. Rural residents who rely on cars, older properties with poor insulation, and lower-income households may face disproportionate pressure. Businesses may pass higher operating costs onto consumers, raising prices across transport, food, and services. Although government support schemes may exist, they rarely cover full costs, leaving families to absorb gradual but persistent increases in monthly spending. Preparation focuses on efficiency and planning rather than avoidance. Improving home insulation, reducing energy waste, and comparing suppliers can soften rising bills. Some households may benefit from energy-efficient upgrades or transport changes over time. Budget reviews help reveal where higher environmental charges will hit hardest. Understanding how green policies translate into personal expenses allows earlier adjustments, preventing sudden shocks. As these taxes evolve, awareness becomes a financial tool, enabling households to balance environmental responsibility with stability, protect cash flow, and adapt spending habits gradually while maintaining control over long-term financial well-being during ongoing transitions. This perspective supports smarter choices, realistic expectations, and calmer decision-making, especially for those already managing debt, carrying responsibilities, or fixed incomes, ensuring that environmental progress does not unintentionally undermine household security or long-range planning goals during periods of policy change and rising uncertainty nationwide for many families. Number 6. Digital services and online income reporting rules. By 2026, the UK is expected to tighten rules around digital services and online income reporting, affecting people who earn money through apps, platforms, or side work. This includes income from freelancing, selling goods online, content creation, and short-term rentals. Platforms may be required to share user earnings directly with tax authorities, reducing gaps in reporting. What once felt informal or occasional may now be treated as clearly traceable taxable income. For many individuals, this shift changes how side income is viewed and managed. Small earnings that were previously overlooked could now push people above reporting thresholds, increasing tax obligations. This can affect students, part-time workers, retirees, and full-time employees supplementing income online. The psychological impact matters too, as uncertainty around compliance may discourage people from exploring flexible work unless they understand the rules clearly and early. Preparation starts with awareness and record keeping. Tracking income, expenses, and dates helps reduce stress and prevents errors if reporting becomes mandatory. Understanding allowances, deductions, and when registration is required can protect net earnings. Using separate accounts for online income may improve clarity and control. These rules are not designed to stop digital work, but they do formalize it. Knowing how digital income fits into the wider tax system allows people to adapt confidently, protect cash flow, and continue earning flexibly without fear of penalties. Sudden bills or compliance surprises as digital regulation becomes a permanent part of everyday financial life in the modern economy. Early understanding empowers better planning, reduces mistakes, supports confidence, and helps households integrate modern earning methods into long-term financial strategies, responsibly and sustainably over time. Number 6. Digital services and online income reporting rules. By 2026, the UK is expected to tighten rules around digital services and online income reporting, affecting people who earn money through apps, platforms, or side work. This includes income from freelancing, selling goods online, content creation, and short-term rentals. Platforms may be required to share user earnings directly with tax authorities, reducing gaps in reporting. What once felt informal or occasional may now be treated as clearly traceable taxable income. For many individuals, this shift changes how side income is viewed and managed. Small earnings that were previously overlooked could now push people above reporting thresholds, increasing tax obligations. This can affect students, part-time workers, retirees, and full-time employees supplementing income online. The psychological impact matters too, as uncertainty around compliance may discourage people from exploring flexible work unless they understand the rules clearly and early. Preparation starts with awareness and record keeping. Tracking income, expenses, and dates helps reduce stress and prevents errors if reporting becomes mandatory. Understanding allowances, deductions, and when registration is required can protect net earnings. Using separate accounts for online income may improve clarity and control. These rules are not designed to stop digital work, but they do formalize it. Knowing how digital income fits into the wider tax system allows people to adapt confidently, protect cash flow, and continue earning flexibly without fear of penalties. Sudden bills or compliance surprises as digital regulation becomes a permanent part of everyday financial life in the modern economy. Early understanding empowers better planning, reduces mistakes, supports confidence, and helps households integrate modern earning methods into long-term financial strategies, responsibly and sustainably over time. Number 8. Wealth and savings allowance reductions. By 2026, changes to wealth and savings allowances may significantly affect how much of your money remains tax-free. Allowances on interest earnings, dividends, and certain investment gains have already been shrinking as and further reductions could bring more everyday savers into the tax net. People who rely on savings accounts for security rather than growth may feel this most, as even modest interest can become taxable once thresholds are lowered. The impact often appears quietly. Interest earned across multiple accounts can add up faster than expected, especially during periods of higher rates. Retirees, cautious savers, and families holding emergency funds may see unexpected tax bills despite taking low-risk approaches. This can reduce confidence in traditional saving methods and push people toward unfamiliar financial products. Without clear planning, money set aside for stability may lose value after tax, weakening long-term financial resilience. Preparation focuses on structure rather than drastic change. Using tax-efficient accounts such as ISAs helps shield interest from taxation. Reviewing where savings are held and how interest is paid can improve outcomes without increasing risk. Some households may spread savings across family members where permitted, while others rebalance between cash and long-term products. Awareness is the most powerful tool. Understanding how allowances work allows people to protect returns, maintain flexibility, and avoid surprises. As savings rules tighten, thoughtful planning preserves control and ensures that careful savers are not quietly penalized for prioritizing financial security and responsible money management over unnecessary risk. Number 9. Self-employed national insurance changes. Self-employed national insurance contributions in the UK are expected to change by 2026, altering how freelancers and contractors manage their income. Proposed reforms may adjust rates, thresholds, or calculation methods, reducing take-home pay without changing headline earnings. Many self-employed workers already face irregular cash flow, so even small increases can feel significant. These changes matter because national insurance directly funds state benefits, yet rising contributions shift more financial responsibility onto individuals who lack employers. Support. For gig workers, consultants, and sole traders, higher contributions can affect pricing decisions and long-term planning. When taxes rise, many must choose between increasing fees or absorbing costs, both of which carry risk. Those nearing retirement may struggle most, as higher contributions arrive when savings capacity narrows. Combined with inflation and uncertain demand, national insurance changes can quietly erode financial stability, especially for people without access to sick pay, pensions, or paid leave. Preparation focuses on budgeting, pricing, and forward planning. Tracking income monthly helps estimate future national insurance liabilities more accurately. Setting aside a percentage of earnings prevents shock when payments fall due. Reviewing business expenses, allowable deductions, and contribution classes can also improve efficiency. Some may adjust work structures or seek professional guidance to remain compliant while protecting income. Awareness allows self-employed workers to respond strategically rather than reactively. As contribution rules evolve, informed planning supports stability, preserves flexibility, and helps individuals maintain control over earnings in a system where responsibility increasingly sits with the worker rather than an employer. This approach strengthens confidence, reduces stress, and enables sustainable decision-making despite policy uncertainty, income volatility, and limited safety nets common across independent work arrangements in modern economies. Number 10. Benefit and support eligibility rule changes. Benefit and support eligibility rules in the UK may tighten by 2026, reshaping how households access financial assistance. Governments often adjust thresholds to target spending, which can reduce access for people just above eligibility limits. Changes may affect universal credit, housing support, and pension-related benefits, altering monthly income for low and middle earners. Even small income increases can trigger benefit reductions, creating sudden gaps between earnings and expenses that households did not anticipate. The impact of these changes is often strongest for pensioners, carers, and families balancing work with rising living costs. Losing partial support can increase reliance on savings or debt, reducing long-term stability. People may work additional hours yet still feel worse off due to tapered benefits. This dynamic discourages progress and increases financial stress, especially where rent, energy, and food prices continue rising faster than wages. Preparation begins with understanding how means testing works and reviewing income regularly. Reporting changes promptly helps avoid overpayments that later become debts. Exploring available exemptions, local council support, or transitional protections can soften sudden losses. Budgeting for scenarios where support reduces builds resilience. Seeking guidance from advice services improves awareness of options. Staying informed allows households to plan employment, savings, and retirement decisions more confidently. As eligibility rules evolve, knowledge becomes protection, helping people adapt without panic, preserve independence, and maintain financial balance during policy transitions that increasingly influence everyday household security. This awareness reduces confusion, limits missed claims, supports fair outcomes, and ensures vulnerable groups respond early rather than reacting after payments stop deadlines. Pass or financial pressure escalates beyond manageable levels for households already managing uncertainty during changing benefit frameworks nationwide over coming years with clarity intact. As 2026 approaches, the financial landscape in the UK is shifting in ways that directly affect everyday life. These changes are not limited to high earners or large investors. They reach into household bills, savings accounts, property decisions, online income, and long-term retirement plans. What makes these updates challenging is their gradual nature. Small adjustments to thresholds, allowances, or eligibility rules may seem minor at first, but over time they can reshape how much money stays in your pocket. Awareness is the strongest advantage in periods of policy change. Understanding how new taxes and laws interact with personal income, assets, and benefits allows individuals and families to make informed decisions rather than rushed reactions. Preparation does not always require drastic action. Simple steps such as reviewing budgets, tracking income sources, and reassessing financial goals can reduce uncertainty. Early planning also creates flexibility, which is essential when rules evolve faster than wages. These developments highlight the importance of staying engaged with financial policy, even when it feels distant or complex. When people understand the system, they regain control over choices that affect security and independence. While professional advice is valuable for personal circumstances, knowledge remains the foundation of financial resilience in changing times. If these changes made you rethink your financial plans, share your thoughts in the comments. Support the channel by liking and subscribing. It helps us keep breaking down complex topics clearly. Watch our related videos to stay ahead of upcoming changes that could impact your money.